We're delighted to present a fireside chat on the future development of crypto. So I'm going to be asking you to multitask, eat, and listen at the same time. Our expert speakers will be discussing the latest trends in the crypto market and the impacts of increasing interaction between traditional finance and decentralized finance. It's definitely a hot topic, we know that, and we're fortunate to have the best in the business to unpack it for us. So I'd like to invite to the stage our panelists, Mr. Korbinian Ibel, Director General, European Central Bank, and Mr. Naveen Mallela, Global Head of Coin Systems, Onyx by JP Morgan. And chairing the discussion is Mr. Arthur Yuen, Deputy Chief Executive, Hong Kong Monetary Authority. Please join me in giving them a warm welcome. Over to you, Arthur.
Thank you, Karen. Thank you for the introduction. And welcome, Korbinian, and welcome, Naveen, to this session. You can keep eating, don't worry. I promise this will be a very interesting session with these two gentlemen. Just make sure that, I need to make sure that you be largely finished with your main course before we come up with the more exciting part of it, so that you won't spit things out. So good afternoon, everyone. It's not just to the audience in this room, but also welcome back to all the audience who are watching it online. We're streaming it live on TV as well as online, so welcome back to this session. I hope all the audience, whether you're here or online, you have been enjoying the program so far. You are learning the latest developments as well. Now that lunch more than halfway through, I think it's time to discuss something very clearly sort of embedded in our mind recently, having looked at the more recent events in the past few weeks in particular. So we are going to talk about the future of crypto developments, in particular the linkages with the traditional financial system, the banking world in particular. Actually, before I come up to the stage, I look at the topics that we have picked for this session. The topic was described as banking after crypto shock. For a while, I thought about having to change it around crypto after banking shock to be more reflective of the latest situation. But nonetheless, regardless of which comes first, the topic actually signifies the fact that perhaps the traditional financial system and the crypto world are probably already linked together in some shapes or form, probably more so than we sort of expect, judging from the incidents that we have seen in the past few weeks in particular. So joining me today to discuss these two, Korbinian, thank you very much for coming, and Naveen. Korbinian, he is in charge of supervising universal banks and diversified lenders. He's also the co-chair of the Basel Committee's Policy and Standards Group. And also Naveen. Naveen is a very interesting character because he straddles the dark side and the light side. He leads the coin system project globally for Onyx by JP Morgan. And in that role, as part of that role, Naveen is responsible for launching a new product in JP Morgan Payments based on digital currencies and extending his work on JPM Coin, for which he was the chief designer and the product lead. So you can tell from the stage that the person who looks most like a tech guy was on that side. A partial tech and traditional finance guy is in the middle, and I'm really a very old-style banking supervisor. So to start this discussion, I think it's fair for me to say that the crypto world has been facing a lot of uncertainty since 2022, particularly after the collapse of Terra and FTX. And more recently, the voluntary liquidation of Silvergate, and then the collapse of Silicon Valley Bank, which is a bank providing services mainly to tech startups, have again highlighted or focused our attention on this issue about the interlinkages between banking system and the tech and the crypto world. So in the case of the recent failure of the banks, for example, the SVB case, the loss actually came from the liquidation of its bond holdings in order to match liquidity needs, and therefore hurting the balance sheets of the bank. So as we have heard in the first panel, it was liquidity problems, but nonetheless, the bank was serving the tech community, mainly focused on that sector, and therefore the linkages became highlighted in that failure. So with that sort of a spillback effect clearly demonstrated, if I may start by posing two foundational questions to our panelists today. So Korbinian, from a supervisory perspective, having seen what we have seen in the past few weeks, do you think we should really adjust the way banking supervisors assess and supervise banks that have a closer linkages with the crypto world?
Yeah, thank you, Arthur. And first of all, thanks a lot for the invite and the hospitality in the last days. It was really excellent. I think the first thing is that we need to do is, crypto is always used one word, but it describes a lot of different things, right? It describes different technologies, different risks, different assets. And I think we need to first distinguish a little bit what we are talking about. Are we talking about we supervise customers, customer protection, money laundering? Are we supervising investors in crypto? If they are banks, then it's prudential regulation. Is it crypto custodian, crypto exchanges? So I think to say now, do we have to change supervision? We first need to think about, do we already supervise properly? And most probably, we have to say we are in the starting phase, in the setup phase. We are building up supervision regulation, but globally we are definitely not there yet. Where we made a big jump, and this is I think where Arthur and me can both be proud about, and the entire Basel committee, we have now a Basel standard that basically regulates worldwide, or at least gives the regulation that has to be implemented worldwide on how banks should treat crypto as their investments. On this side, maybe there are one or two details that we have to really check. We have to check if we want to analyze if a stablecoin is really a stablecoin and what kind of reserves it has, whether uninsured bank deposits are valid for a stablecoin after the experience we just made. But these are details. The rest, I think, of this regulation that we created in the Basel Committee will hold its test. The other parts, there I think is even more setup phase. The FSB is currently doing work, you know, the different jurisdictions are doing work. I think for them it's all much too early. First we need to approve the regulation, and then we need to implement it, and then we need to observe it for a little while. And once we have observed it, then I think we can take a lessons learned. But the current turmoil we see has very little to do with current regulation. What we see, I think, if we look at tax and crypto and the spillovers by the banking system, is that I think we need to do even more in educating people how to do financial investments. And that putting all your eggs in one basket, even if this one basket is one bank, and it's a regulated bank, is a little bit too many eggs in this one basket. But this is nothing necessarily for regulation alone. This is also a lot of bank management and risk management in crypto and risk management in tech companies.
Yeah, thank you very much, Korbinian. I agree with you totally that there are so many things that we still need to really feel our way through going forward. You mentioned the package of prudential treatment of virtual assets that the Basel Committee published in December last year is supposed to be implemented on 1st of January 2025, so there's not a lot of time left, but there are still some outstanding issues that we need to work on, and the recent incidents have actually shed lights on some of the topics that we need to work on, like composition of reserve assets of crypto schemes or stablecoin schemes. So indeed, we should actually work harder on mapping out the risk. But turning to looking at it from a more tech perspective, Naveen, what does the recent incident sort of tell you from a tech perspective? Have you seen any major trends evolving after, for example, the collapse of SVB? What does it mean to the crypto world generally?
Yeah, first and foremost, thanks for having me, Arthur. A very good afternoon to everyone. I will echo the comments that Bill made in the morning that from my standpoint, this is a a very intimidating set of central banks, regulators, and policymakers. And that impression only got reinforced as I sat in through the technical discussions over the morning. But during the course of this conversation, what I hope to do is probably give a view from the trenches in terms of how we are pushing innovation forward on wholesale banking infrastructure. And we hope this will deliver the much needed systemic improvements for the infrastructure as a whole. Coming back to your point, Arthur, I view sort of the current events as the failure of the 3 S's and the impact on crypto, right? Like the Silvergate Bank, Signature Bank, and Silicon Valley Bank. So what does this mean for crypto? And as Korbinian had touched, crypto is an all-encompassing word, but I'll touch upon 2 specific areas. The most visible impact has been the depegging of USDC. And again, Korbinian has touched upon that a little bit, where the peg had dropped to 87 cents to the dollar, and it was only restored after the deposits were fully insured. Now, that puts a little bit of dent to the narrative from stablecoin issuers who've always maintained the position that stablecoins are safer than banks because they don't indulge in lending activity. Clearly, that's a simplistic narrative. You not only have issuer risk from a stablecoin standpoint, but as recent events have proven, on the asset side, there is market risk, there is concentration risk, there is counterparty risk, so there are all of that. The second part is, in terms of what it means for crypto, is payments. Payments are mostly invisible. They're behind the scene until they're not. And what has come to the fore is that with the failover of the Silvergate Bank and Signature Bank, which did a good job in terms of providing 24/7 payment infrastructure, which was the need for the digital asset firm, that no longer is there. Payments serve an important economic function for any transaction, and in particular, crypto trading activities as well. So in the short term, what this means is that there will be a lack of liquidity in the space. There will be lack of settlement efficiency in the space. And over the medium to long term, what we think will play out is that stablecoins will need to prove their viability. There needs to be clearer and stronger regulation. And there is also need, perhaps, and this is the argument that we've been making, for GSIBs to enter into this space. We think that globally systemic important banks who are prudentially supervised and regulated, capital ratios, liquidity ratios, yes, that doesn't mean that you're not subject to risk, but the risks tend to be better managed. They need to come in and provide products in the digital assets and the digital currency space. We've been advocating that GSIBs are best placed to provide things like deposit tokens, which will form a compelling alternative or a compelling complementary products to stablecoins out there. And this will be the cornerstone of digital currencies.
Yeah, thank you, Naveen. You used the word stronger, a clearer and stronger regulation. We can come back to that point later because we have always heard the notion that regulation would stifle innovation. So how do we strike a balance between clearer and stronger regulation and continued support of innovation in the market? We can come back to that later. So thank you very much for those remarks, which I think sets the stage for our subsequent discussions very well. Now, if I may sort of take our minds outside the confines of the recent events and back to 2022, if we look at what happened to the crypto world in 2022, it really plunged from a DeFi summer into a crypto winter. And then subsequently, there were lots of debate about whether that would, the glide path, whether it would get into a crypto spring or an ice age. The recent incident seems to be pushing it further into a springtime rather than ice age in terms of crypto world, judging from the valuation of some of the assets that we've seen. But nonetheless, having seen what we have seen, indeed, I can come to 2 possible sort of very conjectural, I have to say, conclusions. One is if the crypto winter didn't kill it, probably it is there to stay for longer than we originally expected. And secondly, You already mentioned regulation. Probably we have to start thinking about how can we at least put some of the crypto activities that we think are of greater economic value into the realms of regulation. So against that backdrop, I would just like to ask my next set of questions in a more forward-looking space so as to map out what you think would happen in the next few years. So let me start by Korbinian again. Is it really possible that we bring some of these players into the regulatory perimeter? In Europe, you have MiCA. How would MiCA change the landscape for crypto players? And how would that change the way banks actually interact with these crypto players?
Yeah, so regulation in general of crypto will, I think, remain a very broad field. As I said before, I think just calling it crypto is not doing it justice because it's too many different aspects. Now, MiCA basically is grabbing crypto always at the interlinkages to the real world, or to the real financial world. And I think this is a clever way to do it, because you will not be able, or not so easily, at least not now, to regulate something that has not a real owner, not a real administrator, but that is basically an enormous large mass of things, people, computers, machines. You know that much better than I will ever do. But what you can see is where does real money enter the system and where does it exit and where is it administered and settled. And this is where basically this regulation is attaching itself. And then I think we have to see that we have different parts that we need, again, to regulate in a different way. There's the technology that banks use, that is crypto technology, but you use it in a different way. And I think this is what you are working on. Again, under your control, I think the breakthrough we still wait for. Yeah? So we have seen a lot of experiments, we have seen things happening, but the real breakthrough where it's getting real traction, still we need to see. The regulation we need to do there is all about operational risk, operational resilience. Because if banks focus on such a technology and it fails, we need to make sure that the banks have the ability to come back quickly. Then we have all the kinds of stable coins which might make things more efficient. But in reality, it's replicating a real life asset, a token, which might be good because it might have advantages. Here we need to make sure that it's really replicating a real asset. This is what we also do in the Basel standards, with a lot of very detailed tests to make sure we sort it only in this group if it is this thing, a stable coin. And then we have the ones that are speculative. I know maybe there are lots of people who say it's not speculative, there is a real reason for that. I'm still to be convinced of that. I think it's speculative, mainly. And I think on all of these we have to be careful. For the banking world, the way we regulate and supervise, at least what we have produced in this Basel standard, I think we can say it has a safety belt. If you think about the high standards you have to have before you group something as a stablecoin, it has brakes because you have very high risk-weighted assets if you have it on your bank's balance sheets. It has an ABS system, and so this is something like you allow hedging only in limited cases. And it has on top emergency brakes. This is the 1% to 2% exposure limit. You see, I'm German, yeah, so I'm build up. Some people use soccer, I use cars usually as examples. So if you look at a car, I would say this is a very safe car by now, regulated to a lot of safety. Now, banks will start using it. And the balance we need to achieve is not killing innovation and still making sure that we don't have the negative spillovers of accidents. This is the fine line. And I think on this one, we will have to revise again and again in the future because the technology will develop, people will develop, behaviors will develop, risk management will develop. And I think on this one, as it's innovative, as it's evolving, we will need to revise this every 1, 2, 3, 4 years and just check if we can continue or have to adapt, and we need to be very open about that.
Yeah, Thank you, Korbinian. So am I right to interpret what you just said as thinking about the crypto impact on banking, the banking scene as more evolutionary than revolutionary, that you don't think there will be fundamental changes to the business models of banks? I'm putting words into your mouth, I know.
I think it depends on this breakthrough. As long as there's no breakthrough, fully exactly right, but who knows what it will be and when it will come. I mean, if you imagine the introduction of smartphones or the mobile phone, nobody would have imagined it to explode suddenly, but it did, and it changed a lot of things. So I don't know if something disruptive is coming. If I would know, most probably I would be rich. But I don't know, so I'm sitting here.
Yeah. But before we come on stage, I was actually chatting with Naveen about what they're working on in terms of the basic infrastructure. And it sounds like a very breakthrough-ish type of concept. So let's wait and see what's going to happen there. But Naveen, turning to you, the same set of questions. What do you think would be the impact of bringing crypto into some form of regulation would have to do with the crypto world as well as the banking world?
Yeah, and maybe Arthur, to what Korbinian just said, right? Like, I stand on the other side of the argument.
Is that the dark side or the bright side?
Always on the bright side, always on the right side. But in terms of we see it as revolutionary, not evolutionary, and I'll maybe just sort of uncover a little bit in terms of why we have that view within JP Morgan Onyx. So if you look at the last 15, 20 years, innovation largely has been driven by digitalization. We think that the digitalization wave is coming to an end. I think the next wave of innovation will be tokenization, for sure. Now, what do we mean by that, right? Like, what does tokenization really mean? We think that the potential of multi-asset ledgers, where you have cash, where you have assets, and where you have information all natively on a single ledger, unlocks exciting new possibilities. One of the products that we've launched, and this is not just conjecture, right? Like, we've been actually working on that for the last few years. One of the products that we launched is an intraday repo. A repo which just exists for 2 hours or 3 hours. The ability to source liquidity in a DVP manner against tokenized securities. Now, that is something which was not made possible by traditional infrastructure. Because if you want to do a repo for a duration as short as 2 hours or even lesser, for example, your infrastructure where securities are moving on one ledger, cash on another, you need to reconcile. I mean, it was not going to happen. I would make that argument that increasingly, if anything, that the Silicon Valley Bank failure has taught us, one of them is about sourcing liquidity at the right time. One of the things which is not spoken about enough is the fact that Silicon Valley Bank was unable to execute a repo transaction because of cutoff times. So the ability to move into 24/7, the ability to tap into multi-asset ledgers to execute repo-based transactions, the ability to stand up institutional pools of DeFi, which is some of the work that we've been doing with MAS as part of Project Guardian, all of these will have a revolutionary impact in terms of how wholesale markets work. We think that it will fundamentally remove the burden on CCPs, which are heavily capitalized and collateralized. So it will free up all of that because you can execute natively delivery versus payment within the same block. So those are some of the benefits that we are after. We think that despite everything which is being done around cross-border payments, for example, it still is, there are a number of breaking points, there are a number of pain points which still persist. They will only go away once you have token-based infrastructure where you have peer-to-peer cash, which is happening. So from all of those standpoints, we are excited about what we can import from crypto technology into the banking space. And to your earlier point in terms of, do we think that regulation will stifle it? Absolutely not. In fact, we would have made far greater progress on some of these initiatives if we had regulatory clarity. Like when we think about some of the work that we've been doing in deposit tokens, we've not been able to forge ahead because of lack of regulatory clarity. So our view is, regulatory clarity drives innovation, at least from our standpoint, and not stifle it.
So regulatory clarity in the sense of knowing how it's going to be risk-weighted if it happens in the banking space, or what?
How is it going to be risk-weighted? Like, for example, what are going to be the AML obligations around it? The fundamental notion of a deposit token means we do introduce bearer instrument-like properties. I know bearer instruments is not something that we've traditionally favored, but the fact that you have digital identity, the fact that you have the ability to do on-chain surveillance, all of that means you have controls around how you can approach the problem which bearer instruments had in the past.
Oh, by the way, before we move on, let me just remind the audience that we did actually reserve a small amount of time towards the end for questions from the floor. So if you have any questions, you raise your hands at the end of the session, and then we'll pass you the microphone. So talking about regulation, there's always two aspects to it. One is the regulation itself. Of course, the other one is the implementation agent, being the supervisors ourselves. So if we are talking about regulatory clarity, bringing some of the activities, some of the value propositions within the regulatory perimeter, what next set of questions would be, what do you expect to be the challenges that the regulators would face? So Korbinian, but as a very specific angle I would like to sort of pick your brain on, we supervisors always proclaim ourselves to be technology neutral. Increasingly, I don't know what that term means. But isn't it true that we have to devote much more time in at least understanding some of the things that Naveen just talked about? I have to admit that I don't understand all of those. Not sure about you, but isn't it true that we have to spend much more time in doing that? And that's not really a tech-neutral way of supervising. And also, isn't it true that our capacity in understanding those would need to be substantially enhanced?
I mean, I think it would be very boring if I just say yes, right? But I do totally agree with you, Arthur, we do. I mean, the first thing is, what is tech neutral, right? Tech neutral means not that you can use whatever technology you want and we will just look away. That's not tech neutral. Tech neutral means that we do not have a bias in favor or against a technology, but we will always take the technology and look which kind of risks are embedded in this technology, and then we will supervise these risks no matter where they are coming from. And the same technology can have totally different risks, like permissionless and permissioned blockchains, right? It's the same technology, but it's a different way it's applied, so you need to supervise it differently. Now, do we need to invest? I think we need to invest heavily. We don't get around. Again, I think regulation will help us because it's categorizing things, and it will help us to basically also eliminate certain risk categories. But we as supervisors will need to invest, and it's not easy to find the people who can do that. So I think all of us in that room who are responsible for supervision will face a challenge here. And I think the industry will also need to do their part, because we need to make sure that education in universities, etc., is building up, that people come into the world basically crypto-literal and techno-literal, more literal than they are today. So this would be my answer on that.
Yeah, but I have to say that the past 2 years, both at the FSB and the BCBS, we have spent quite a significant amount of our resources in this particular area. And I do believe that our understanding of the subject has increased substantially. So there will be more policy or recommendations coming out from the two organizations. So I do urge the audience, whether you're here or online, to watch out for that. But now let me turn to Naveen from the bank's perspective. I'd really like to hear from you. How would you go about convincing the supervisors that whether it's DLT or stablecoin-based sort of use case is actually safe? If you are bringing that into the regulatory perimeter, you only need to regulate up to this level and not that level, and it will still be safe. How do you actually convince us?
So this goes back to the point again Korbinian made a little bit earlier in his statements around operational risk. And I'll give you an example, right? Like when we launched JPM Coin in 2019, 2020, we were grappling with like, how do we think about the product? We ideally wanted to launch something which was akin to a stable coin. But again, given the fact of lack of regulatory clarity, and given that we wanted to take small incremental steps to ensure that we are conducting this activity in a safe and sound manner. So what we did was we took an existing product characterization. We took what was typically a bank account, we took a regular deposit account, and we put it on chain. So from a legal standpoint, it's no different from a general liability of the bank. From a regulator standpoint, it's no different from a demand deposit account. But from a technology standpoint, it is different because it sits on a distributed ledger. What we've also ensured was to get our regulators comfortable that the controls around it, whether that is the sanctions, the AMLs, the monitoring controls, all of that still tied back off-chain to the current set of systems. Now, what this means is that this is an onerous undertaking to do. And the benefits are not immediately apparent, but you start taking those small steps towards the journey. And in many of these instances, with disruptive innovation, you learn by doing, right? So, and we wanted to take these small steps towards that. The next step that we took was we built this JPM coin, which is within the JP Morgan infrastructure, 24/7 ledger, which can do stuff like intraday repo, which we couldn't do earlier. The next step was, how do we start externalizing it? And that is where we worked with a few other banks, set up Partier, stood up a shared ledger infrastructure. I think one of the fundamental things, if you want this to be a revolutionary undertaking, is that you have to change the infrastructure. You have to get banks moving away from their own isolated, siloed ledgers to a shared ledger infrastructure. So that's the next step that we've taken. The third step that we would ideally like to take is deposit tokens. And the idea that you can create a bearer instrument like peer-to-peer money, which solves for a lot of the problems that we have in terms of how money moves on cross-border from account to account to account with breaks and reconciliation. So that would be my response in terms of taking those incremental steps, always keeping the regulators informed on how we are managing the risks around it, learning by doing, and also collaborating. If we've collaborated actively with BIS, whether it is Project Dunbar, HKMA, and BIS with Enbridge projects, you're doing a lot to bring the industry and the regulators together to sort of experiment. And some of these experiments have given us the learnings for us to develop our products.
So Naveen, you actually sit, you are a tech person sitting in a broader sort of banking or financial perspective. Would any of those answers have changed if you are sitting completely outside the perimeter as a purely tech person?
For sure, right? For sure. I would have wanted to jump straight into the deposit tokens part of it without having to take those small deliberate steps. But the fact that, yeah, I mean, we are heavily regulated. There are elements of how you're going to address operational risk. Getting the entire machinery, the bank and our regulators comfortable means that we'll have to undertake this, a bit of an arduous journey, I would say.
Okay. Thanks for being so frank with us. We have about 10 minutes left for this session, so if I may ask whether there are any questions that the floor, okay, Rebecca, can somebody hand a microphone to Rebecca?
Thank you very much. I have a question for Naveen, or maybe two. You were mentioning that tokenized deposits is a promising way for banks to get involved on this. You were not mentioning stablecoins. Do you see also a role on that front? And second question, how do you see the interaction between these tokenized deposits and the potential development of a CBDC, of a sovereign digital currency?
Thanks, Rebecca. Thanks for your question. So maybe to answer the second part of your question, how do we see the interaction between CBDC and tokenized deposits? Actually, I'd use this opportunity to, sort of put together the taxonomy, which we are quite passionate about. We'd like to call it deposit tokens rather than tokenized deposits. And while on the surface it might seem semantics, it is not. Like a tokenized deposit alludes to the fact that there is a deposit somewhere in the real world that you're tokenizing on chain. But the way we think about deposit tokens, it resides natively on chain. It's not a representation of some real world asset which is encumbered anywhere else. But semantics and the taxonomy aside, I get asked this question often: what's the role of commercial bank money in a world of CBDCs? And we've always steadfastly held the view that central bank money we don't think is going to crowd out commercial bank money. Today we have a two-tier system operating very well of central bank money and commercial bank money. We don't see that changing in the world of digital currencies. And if you think about the dominant form of payments today, it is based on commercial bank money. We don't think it will change going forward. There will be use cases for CBDCs. We particularly think central bank digital currencies as a risk-free settlement asset, particularly in the wholesale sense of security settlement. There will be use cases around that. But for most use cases, it will be based on commercial bank digital currencies. So that is how I see the interplay between the both. Central bank digital currencies will create that fungibility and that oneness between multiple commercial bank issuers. Now, to the point about stablecoin issuers, I would see very much in terms of how today e-money, deposits, central bank reserves, how all of that interact, the same thing playing out in the digital currencies world. I would see stable coins as the equivalent of e-money. I would see deposit tokens as the equivalent of deposits, and you have CBDCs as reserves. I don't think that stable coins will in a major way displace commercial bank money, because the one-to-one backing means that it crowds out liquidity and it does not scale. There is no money multiplier, there is no fractionalization, who's creating risk assets if there is a large place displacement of deposits. So that's the reason why how we see all three of them interacting.
Yeah, thank you. No follow-up question from Rebecca. All right. Okay. Any other questions from the floor? No? Oh, there's one over there. Daryl?
Thank you, Korbinian and Naveen. I think I do have a question for Korbinian. When we work on those Basel standards on crypto assets, and we try to actually capture a lot of stable coins and put it under our regulatory framework. For instance, we may impose certain requirement on the reserves management, as well as having the stability that we require them to be able to deliver the function as a stablecoin. So do you expect that there will be more and more banks enter into this space because they are already regulated entity, so they are going to becoming the major issuer of stable coins in this space? Or we should actually expect the existing dominant stablecoin issuers will be gradually coming under our regulations? So which way would be the more likely scenario in your view?
Well, that's a super question. Thanks a lot. Hard to say, I think. Hard to say. I would say if we get regulation right, then in the end it should not matter. It should not matter, because then both sides should have basically the same chances and the same advantages. Most probably, if banks ever really jump on it and have the breakthrough and can use the regulation that we establish as a clear guiding principle what to expect, then I think the trust that customers have in banks might lead to a very quick multiplication of bank success in this field. This is where we also have a responsibility, I think, as supervisors and regulators, very much so. I mean, banks, in the end, will be using the technology, this is for sure. They will be using it to get more efficient, to have new products. They might be using it as hedging. They might be using it as investments. So, and whatever they use it for, the thing they need to create first is a good risk management on it. And if I look at the banks, the bigger ones who start experimenting and testing, I think what they build up is skills to do a good risk management. And this is why I also think that we as supervisors should not limit them too much too early, as long as it's little sandboxes, because otherwise we would cut off their way of gaining the knowledge to later, if there comes a breakthrough, be even able to risk manage in a proper way. This balance, I think, this is where it's more art than science.
Thanks, Korbinian. I do have a question. If there's any more questions from the floor? Oh, there's one. Sten?
Yeah, thanks very much. You mentioned, Naveen, the shared ledger, and you also mentioned the necessity to preserve the oneness of money. But I do wonder, when you have a deposit tokens or tokenized deposits, whether you can do that. We have a big apparatus to preserve the singleness of money in a two-tier system. Even that doesn't work necessarily perfect, because we do see some differences there. But how do you achieve that? The shared ledger is just a mechanical way, but does it actually assure that you have this singleness among those deposit tokens?
Yeah, thanks for the question, Steen. I don't think we see shared ledgers as ensuring or assuring singleness of money. My point really was around, as GSIBs, we have the ability to interoperate between multiple payment infrastructures. So whether that is RTGS systems, real-time payment systems, or distributed ledger. What creates that singleness is, A, the ability to move liquidity seamlessly between all of these different infrastructures. I think that is critical. One of the reasons why we feel that stable coins don't trade at par necessarily at all time is because of the friction in on-ramp and off-ramp and moving liquidity around. The second is the fact that to create singleness of money, like as digital currencies expand and scale, CBDCs become critical. So without central bank money creating that fungibility across multiple commercial bank issuers, and if you always have to go back to RTGS systems and settle amongst each other and have bilateral credit exposure, that starts breaking the singleness of currency. So we do think that CBDCs, especially wholesale, is going to be the cornerstone for ensuring that. So my response is twofold. A, CBDCs are a necessity, and B, GSIBs or banks generally who interoperate across multiple current infrastructure and future infrastructure, these are the things which will ensure singleness of money.
Thank you. Thank you very much. Any more questions from the floor? Oh, there's one at the back. Raymond?
Thank you, Korbinian and Naveen. I have a question for Naveen. Now, the collapse, one of the reasons for the collapse of SVB is a very, very rapid outflow of deposits within a short space of time. We are talking about 25% deposit outflow within a few hours. So my question is, if these deposit tokens or tokenized deposits become very popular, would that increase the liquidity risk exposures of the banks? If that's the case, how will, how should a financial institution be dealing with such risks? Thank you.
Thanks, Raymond, for the question. My response would be to flip it the other way around. I think that the core needs to keep up with the speed of the user interface, to use the analogy. So we think that the behavior in terms of, like, as retail digital platforms become more and more instant and real time, the wholesale financial infrastructure needs to keep pace. So we think that, the world where you have cutoffs, where you have financial market infrastructure which is not 24/7, is only going to exacerbate the problem. We think that the ability to, what I talked about intraday repo, right? The ability to actually tokenize collateral and access liquidity with peers or through institutional DeFi pools means you create more optionality in sourcing that liquidity when some of this behavior happens. So I think that actually this is the need of the hour to ensure that the response is commensurate with the user behavior that we are seeing.
Thank you. There's another question on this side. Neil.
A question around permissionless networks and whether you think, what sort of controls should be put around them to get comfortable in terms of, both from a risk management perspective and a regulatory perspective.
Who wants to take this first? Naveen?
I'll give my view on that, Neil. We believed in, when we talk about open blockchains or public blockchains, we still would want to have some sort of permissioning in place in terms of accessibility. Like one of the things, when we launch deposit tokens, for example, on public blockchains or open blockchains, we would need to ensure that there is a right identity solution in place so that we can gate who transacts with it. So that is our way of creating some degree of permissioning on open blockchain platforms. So a decentralized distributed identity solution is going to be a critical cornerstone of public blockchains if we have to get there. Till that point in time, you are in completely permissioned land.
Fully agree. This is what I meant before with the entry and the exit. This is where you control it.
Okay. We are right on time. We have like 30 seconds left for this session. So thank you very much to the two gentlemen for the generous sharing. I'm sure, like me, the audience have benefited a lot from that. So let me invite the audience to put your hands together. A big round of applause for the two gentlemen. Thank you.